Hi everyone, I'm JC Xue, one of the multi-counselor portfolio managers on the Foord International Fund, Global Equity Fund, and the Asia X Japan Fund. Today I want to spend some time talking about China's underappreciated innovators, some of which we are invested in. And more importantly, I want to highlight China's rise as a tech powerhouse, as well as the related opportunities and implications. To start, one of the questions we spend a lot of time thinking about is, as global growth slows, how do we drive out performance? And as you can see in the next slide, right, the key that we think about is finding areas of misunderstanding, where the market doesn't want to go, doesn't want to see, doesn't value. There will be opportunities to outperform. So this brings us again to China, where we continue to find just broad market underappreciation, despite some recent market recovery, which is why China continues to make up low double-digit exposure in the Foord International Fund, around 20% in our Global Equity Fund, and more than 50% in our Asia X Japan Fund. I'll start first by examining what the market is not seeing enough of, highlighting cases of how China is no longer just a copycat, but innovating and creating world-class products with global rollout potential. Now let's start with AI. So the chart on the left, you can see a few logos of China AI companies. DeepSeek is probably the first everyone recognizes, being the Chinese language model that took the world by storm just a few months back. And for those who are less familiar, the DeepSeek model performed in many instances on par with the best like ChatGPT, and was priced substantially cheaper for developers to use. And then it saw rapid adoption both in China and rest of the world. But beyond DeepSeek being a global winner, there's also this second logo here, which shows you Kling AI. It's one of the most used video AI models globally. Basically, you can just type in what story you want to create in text, and it creates the video for you. And that third logo is Manus, which is leading in building AI agents, basically AI that can perform tasks for you. For example, you can ask it to make a website, plan a trip, and do bookings for you. So each of these businesses are not just Chinese leaders, but also globally relevant. But I think the important point that I want to highlight here is that these are just 3 out of thousands of AI algorithms that have been created in China as of April 2025. An AI algorithm would include not just language models, but also things like diverse applications like automated advertising creation tools, voice agents for customer service, etc. Basically, the AI ecosystem is blossoming in China with hundreds of new algorithms being launched each month. And by 2026, we think it will grow by another 50%. The DeepSeeks, the Klings of the world is just a start to what is likely to be a lot more to emerge from these thousands of algorithms over time. Now, the other thing to highlight here is the table on the right, which shows the global language model leaderboard. And here you can see companies we own, including Tencent and Alibaba, both having models that rank top 10 globally. You can see Tencent's Hunyuan model ranked number 6, and Alibaba's Qianwen ranked number 8. Now, beyond language models, both of these companies are also rapidly rolling out AI capabilities across their businesses in advertising. AI implementation is driving uplift in ad conversion rates, and you have Tencent adding AI tools to make ad creation much faster. So both Alibaba and Tencent have huge potential to benefit from AI that's not being priced in, especially when compared to the exuberant valuation of certain Western AI businesses today. Now, the next space to touch on is the semiconductor industry. And this chart here shows the semiconductor manufacturing process node progress by years. Right? And you can see the smaller the number, the more advanced the technology. The light blue line is SMIC, which is the national champion of China's semiconductor manufacturing. And the dark blue line is TSMC, the current global leader in semiconductor manufacturing. We can see how SMIC used to be a whole 10 years behind TSMC, at the 28 nanometer node. But over the last 5 years, that tech gap has shrunk to 5 years, despite sanction from US. As a quick recap, US increasingly sanctioned China's access to advanced semiconductor chips, equipment, as well as software. And counterintuitively, this actually united China's semiconductor industry like never before. Before the sanctions, Chinese companies would focus on developing its own chips, own equipment, but often ended up defaulting back to existing Western solutions that were simply better. But after the sanctions, these Western solutions were no longer options. So the entire ecosystem had no choice but to lean 110% into self-sufficiency development. And SMIC has basically defied expectations using older lithography technology to advance chip making from 10 nanometer to 7 nanometer, and is expected to produce as small as 5 nanometer production starting this year. And to advance beyond 5 nanometer, China is also developing its own advanced lithography machines. Huawei and SMIC, for example, are exploring alternate tech paths different from existing ones using machines from ASML. And if it works, they could start mass production by 2026, becoming the first country to develop an alternative solution, which is currently a monopoly business owned by Netherlands ASML. And if we look beyond chip manufacturing, our investee companies like Tencent, Alibaba, and Baidu have been designing and building their own chips for AI applications. Even though chips from global leaders like NVIDIA remain better, the alternatives are starting to emerge from China. Now, the third space I want to touch on is autonomous driving. And here you can see a picture of Baidu's robotaxi being deployed in Beijing. These cars are no longer in test mode, but they're actually actively available in the public across multiple cities, fully autonomous, without safety drivers. And these services are available across 5 major cities, Chinese cities, including the likes of Beijing, Wuhan, Shenzhen, and Shanghai. And there's plans for testing of its services all the way in Europe, in Switzerland, and Turkey. And Baidu is also planning to deploy their first 100 autonomous cars in Dubai by the end of this year, with target to grow the fleet to 1,000 by 2028. So the overall number of the rides and fleet is still small, but as the tech and cost continues to go down, we will see accelerating rollout going forward. And I think unlike Tesla, which is pricing in billions of market cap for robotaxi service that's not even on the road yet, you can see the PE ratio chart on the right, that Baidu is only trading at under 10 times PE, with none of its autonomous driving technology being valued at all. Next up, I'll touch on batteries. China dominates the battery space today, led by CATL and BYD. So CATL is the global leader in EV battery technology with around 40% global market share, has continued to push the frontier of battery development. So you can see on the picture on the left, it's CATL's latest generation of Shenzhen superfast charging battery. This generation just announced the ability to add 500 kilometers of range with just 5 minutes of charging, which is essentially as fast as fueling your car at the petrol station today. And the chart on the right shows the range added after 5 minutes of charging for various companies. And here you can see CATL able to get to 500 kilometers, which is almost 5 times the range that Tesla can get from 5 minutes of charging at its supercharger station. So you can see that the technology lead that CATL has is continuing to widen over Western competition. This new generation of battery can also charge to 80% within 15 minutes in low temperature of minus 10 degrees Celsius, which is 2 times the speed of current industry standards. And beyond Shenzhen, CATL also announced new sodium-ion battery solutions. And just some context, battery makers have been researching sodium-ion battery as a potential alternative to lithium because sodium is abundant, it's cheaper, has a better safety profile. And so CATL's new launch sodium batteries is already pushing range to 500 kilometers with 10,000 battery charging cycle, which is 2 times what a lithium-ion battery can deliver. And the mass production of this sodium technology is going to start by the end of this year. And this is not happening just in China, right? So CATL has a Hungary battery plant that's set to start production soon that will help serve European automakers. And its scale and cost advantage will mean that CATL is going to remain a global leader as the whole world electrify over the next decade. So CATL is a business that we still don't own in the portfolios yet, but are actively evaluating the potential addition in recent months. Now, lastly, I want to just touch on robotics. And here again, when we think about robots, people would say Elon Musk and Tesla is, leading the vision of humanoid robots. But what many don't know is China is actually already ahead of the West in this sector. And this chart on the slide just shows the number of humanoid robots unveiled over the last 3 years. And since 2022, China has accounted for more than 2/3 of total new humanoid robots unveiled globally. More than half of all global companies known to be developing humanoids are based in China, driven by local government policy support, the strong supply chain, as well as the talent pool. And just a few months ago, coming right after DeepSeek's viral movement, China's robotics business, Unitree, also went viral. Right? One of its humanoid robot demonstration, the G1 robot, was shown in a video doing backflips, kung fu moves, things that people thought, like, is this an AI-generated video? But then it became clear that the video was real, and the industry marveled at the progress Unitree achieved in substantially upgrading its robot's balance, speed, as well as dexterity. I think all in all, China is in a very good place, leading tech development for robotics as it currently stands. So now we've looked at China's world-class innovation being not fully appreciated. What else is being misunderstood? And I think, certain good qualities that are pervasive across the Chinese society, some of which are entrenched in Chinese culture and history, are also misunderstood by the market. This would be things like speed of execution, resiliency, and long-term thinking. So I'll start with speed of execution. This picture here shows the high-speed rail network map over the years in China. From just having 2,000 kilometers of high-speed rail network in 2010, by 2020, the high-speed rail network in China expanded to 40,000 kilometers. In just a short 10 years, they built by far the world's largest high-speed rail network. And over the next 10 years, this network is expected to double again. And the train technology is also expected to be upgraded, with prototype bullet trains running at more than 400 kilometers per hour. High-speed rail is going to boost connectivity between cities substantially. The flow of people is going to be boosted, as well as businesses, as well as tourism. Now, high-speed rail is not just a unique occurrence, right? You see this speed of execution across real estate, electricity grid, 5G network, EV charging network, you name it. It's truly China's speed. Now, the next I'll touch on is resiliency, where the US sanctioned Huawei back in 2018, banned it from US tech, and forced other countries to replace Huawei technology in their mobile networks. So if you recall, Huawei phones were running head-to-head with Apple iPhones back in 2018. But within months, Huawei's software access was banned, chip access were banned, and US basically destroyed Huawei's smartphone business overnight. And the revenues peaked by 2020, as can be seen on the left-hand side chart, which shows Huawei's revenue progress over the years. But fast forward 4 years. By 2024, revenue has already rebounded close to 2020 peaks. So what happened over the last 4 years? The picture on the right showcases the new flagship Huawei Pura smartphone. Essentially, within a short 4 years, they developed Harmony OS, a self-developed operating system. They no longer need Google, to which they were banned from. They now use Kirin chips, designed in-house and manufactured by China's SMIC. And the amazing thing is, not only did they come back and build their phones, replacing Western tech with domestic tech, they even found time to develop market-leading cars. So the picture on the bottom right shows Huawei's Aito SUV. So this car is better than Mercedes, with significantly better software tech and autonomous capabilities just at half the price for Mercedes. So when we revisited what happened at Huawei immediately after US sanctions, certain anecdotes emerged talking about how some of the engineers locked themselves in for months, not leaving till they developed the domestic replacement solution. You had the founder Ren Zhengfeng rallying the troops to fight. So this was truly the epitome of what doesn't kill you makes you stronger. The resilience of Huawei is what we look for in the best businesses. And it comes in abundance in China, especially when we look through the period of COVID and regulator disruption. There were so many examples of resilience in education and tuition space, for example. New Oriental Education saw half their business regulated away. And then they went and built a new business and achieved record high revenues again in just a short 3 years. So this culture that celebrates resilience is really pervasive across all of China. Now, the last thing I want to touch on is long-term thinking, which is highlighted in how China reformed its education and upskilled the country's most valuable resource, its people and its talent pool. So this chart here shows you the annual science, tech, engineering, and math graduate programs, STEM, essentially in short, across different countries. You can see here how China is projected to have, 4 times the amount of STEM graduates versus US today. And at the STEM PhD level, China is projected to have 80,000 annual graduates, again, around 2 times that versus the US. And this strong STEM graduate output is a direct result of education reforms that were put in place since the 1990s. So back in the 1990s, higher education was largely an elite privilege, just 3% enrollment rate. And the shift to evolve its education system was a long-term commitment over decades. So in the last 30 years, you saw China invest to build its education ecosystem, and tertiary institutions alone grew from hundreds to almost 3,000 today. And this multi-decade commitment remains today, which is going to drive continued talent output and serving as the foundation for China's growth many years into the future. Now let's bring it all back to what this means for investing and valuation. So I've highlighted how one can find best-in-class tech innovation in China, how you can find the qualities of the best companies and people in resiliency and long-term thinking. And the market continues to ignore these values, pricing the China market substantially below that of the US. And to caveat upfront, we fully appreciate that China has challenges, corporate governance issues, etc. But every market has good and bad, and there's no market that's perfect. So let's look at the valuation to see whether things make sense. This chart on the left shows the P ratio of 2 leading retailers. One is JD.com, one of the largest retailers in China, and the other is Costco in the US. And JD is expected to do 10 to 13% earnings compounding going forward, which is higher than Costco's 7 to 9%, but yet it's valued at less than 10 times PE versus Costco at more than 50 times PE. So Costco is valued at more than 7 times higher multiple, despite slower growth. Right? At what point does this valuation gap simply no longer make sense? And then we also look at the table on the right, which is something we spend a lot of time thinking about. It shows the P ratio of some Nifty 50 stocks in the 1970s. It's something we keep coming back to because the Nifty 50s has a lot of similarities to what we see today. Back then, these businesses could do no wrong. They were strong. They had consistent growth, very, very high quality businesses. And the valuations just kept chugging up and up. Very, very similar to what we saw with Costco, Walmart, and many other quality businesses in the US today. But if you bought these Nifty 50s in the early 1970s, many of these names would have given you no returns over the next decade. In the table, the third column, you can see most of these delivered negative annualized returns over the next 10 years. With McDonald's plus 2%, Disney was a minus 4% annualized, Coke even worse at minus 7% annualized, and then pharma giant Merck was 0% over 10 years. All right, so last but not least, I want to just share more food for thought around this chart, which showcases the rise and fall of empires tabulated by Ray Dalio in his book, The Changing World Order. And I bring out this chart because what you find consistently in the rise and fall of empires is that it's driven by tech leadership. So China, the orange line, was a superpower in the 1500s, invented paper, compass, silk. Thereafter, it was Netherlands, the gray line, driven by advanced shipbuilding. Then came UK, the black line, via industrial revolution and steam engine. And lastly, the US, blue line, auto, nuclear bomb, and the information technology era. So as I recounted in the first half of the presentation, probability of China taking that tech leadership from US is rising by the day. There's the ingredients for success around speed, resilience, and long-term thinking. Those things are also there. And when you look at the US market, it's currently priced for exceptionalism to continue, even as risk to that leadership grows. And inversely, China is not priced for much at all, even as it grows in technology advancement. So we find historically, low expectations typically raises probability of upside surprise, which is another reason why we continue to like our positions in China. So finally, to conclude, China is no longer copying. They're innovating and leading the way in many tech sectors. And these tech developments will be supported by a culture of speed, resiliency, and long-term thinking. We think there will be challenges related to the Chinese market, but the valuation gap we see today is simply too large, especially when we start accounting for the positives we see in the country. Now, stepping back and looking at the long-term history around tech driving country power, we see risk to US market priced for perfection and opportunity in a Chinese market that's underappreciated. So this remains why China continues to make up low double digits percentage in our Foord International Fund, 20% in our Global Equity Fund, and more than 50% in our AsiaX Japan Fund. And with that, come to the end of my presentation, and I'll hand it back to Linda.
Thanks, JC. I'm just going to pose a few questions to you before we move on. The first is that one of the reasons why investors are wary of China is that it is a country where information has sometimes been selectively communicated or even controlled. So how do you, as an investor, distinguish between real innovation and marketing hype when it comes to evaluating Chinese companies' claims about where they are in terms of leadership of innovation?
That's definitely a concern. So for us, we approach it across a few ways to determine the sources of information. One of it we spend quite a bit of time doing is doing expert calls with, local industry experts, competitors, as well as some, managers who have left, companies that we're interested to understand more and study more. So this helps us calibrate what's real and what's hype. And then for various businesses that sell their products or software or other things overseas, where we have access to the underlying products, we also endeavor to actually try and test and experience and feel some of the products ourselves so that we have an accurate gauge of what this, development of products actually is. And the last vector that we, constantly go back to is, we visit companies and businesses in China on, multiple trips in a year across the team, right? We'll go for industry conferences, we'll go on investor tours, and, being on the ground really helps us talk to the local people, talk to the local businesses, and ultimately determine the hype versus, again, what's real information.
And also, JC, many investors also make the point that Chinese companies should trade at some kind of discount to the US, because of course there are additional risks. One might argue investing in China, and they would risk, sort of name those potential risks as, corporate governance issues, state intervention, regulatory unpredictability. Firstly, do you agree that some kind of discount is warranted? And if so, how do you determine what an appropriate discount to the US market would be?
Sure. I think, first up, we definitely agree that some level of discount between the Chinese company and US should definitely be there. The question is, how big a discount does it make sense, right? So foundationally, when we think about valuing businesses, right, we project the cash flow out and we discount it back using discount rates adjusted for country risk, right? So in this case, China would typically get a discount rate of anywhere between 10 to 13 to 14% in our valuation models. And if we translate that number into a PE ratio as a shorthand, right? So a 25 times PE ratio US business that's expected to grow earnings X% over a number of years. If there is a Chinese business with exactly the same vectors of growth and quality and so on, putting that higher discount rate typically gets us somewhere close to 17 to 18 times price to earnings ratio. So roughly call it a 30+% discount from a price to earnings ratio shorthand valuation matrix. So again, just coming back to that JD and Costco example, right? JD is under 10 times PE, Costco is 50 times. The valuation gap that we see across multiple sectors and businesses in the market, China, US, the gap is just too big, and that's where we think there's the opportunity.